Dean, welcome again to Australian Fund Monitors. It's been a while since we've spoken. Plenty's happened. I mean, there's been a massive lockdown in Victoria, which is obviously affecting you personally. Is it affecting the fund in any way?
Well, the short answer is no. I guess technology's made things really straightforward in respect to operating the business. If anything, we're probably getting more access to more companies because everything's so Zoom based that we're being able to dial into conference calls that are happening in Brisbane or Adelaide or Sydney as well as Melbourne. So arguably, potentially the quality of meeting isn't quite the same. You can't quite look people as deeply in the eyes to work out if they're telling you the truth or lying. We're certainly getting a lot more breadth of information from companies, which is fantastic. And operationally, the business is fine. Like custody and asset administration, taxation, all that sort of stuff working perfectly. So probably on balance, I'd say COVID from an operational perspective has been beneficial.
Yeah, it's interesting, isn't it? I mean, we've noticed the same at AFM. We're such an internet-orientated, online-orientated business. The only thing we're missing nowadays is lunches, which is probably good. You know, it's saving both waistline, liver, and the bank balance. But we do miss seeing you face to face when we're down there. But how's the fund actually gone in the last couple of months?
Surprisingly well, actually. We've had a couple of fantastic months. July, we're up nearly 10%. We're having a very good August as well. We're up more than 5% already in August. So it's unusual because we're in an environment, certainly here in Victoria, that the economic outlook's been as dire as anyone in their lifetime could ever remember, and yet the performance of the fund and arguably the broader market's been incredibly buoyant. So there's a real contradiction in terms of outlook, but certainly from a fund perspective and from an investment perspective, we're finding it really good at the moment.
It's a paradox, really, isn't it? I mean, the market's down 13% from its high. I mean, so it's only down 13% from its high, and the greatest crisis that's really hit the economy probably since 1929, 1930, if you take the war out of it. That's extraordinary. Does it make you sort of hesitate and think, how long's this going to go on, or is the ice going to crack at some stage?
Yeah, look, it's a good question. It's very hard to get your mind around the fact that you have an economy that is going downwards and a market that's going up, almost in a straight line. I think what we've seen is the real supply of money having a real influence over the stock market. You've got incredibly low interest rates, and so very little return on a whole bunch of asset classes, and so that money just seems to be flying back into the stock market, which is driving up share prices. But there's also a number of sectors that are doing incredibly well from this COVID environment. On the back of government stimulus, there's been huge buoyancy in the consumer sector, and so anything that's really discretionary spending, and certainly online, is seeing this period as good as they could ever imagine, like much better than they would have had in a non-COVID environment, because people are staying at home and sort of spending money, which I don't think people would have really expected would have happened 3 or 4 months ago, but that's what's transpired, and there's companies that are benefiting substantially from that.
Yeah, I think consumer spending is holding up surprisingly well. As long as you're not in the restaurant or cafe trade, you're probably okay. But all this stimulus that's being paid out by governments, both state and federal, and even being able to withdraw super, I mean, it's not being saved, it's being spent, which of course is terrific news for the economy. I think the Treasury would be very worried if it was all being saved and just used for debt reduction. But a lot of people have been recipients of stimulus, and it looks as if they're spending most of that, which is good news for the economy.
Yeah, look, I mean, the other thing to note is that I think a lot of people, spend a lot of money on entertainment, on holidays, on eating out, and drinking coffee and going to breakfast, and the significant amount of that potential to spend isn't there. So people going out and buying a new set of sheets or curtains or a motorcycle or a new bicycle or something smaller, they're probably not going to renovate their house or think about moving at the moment. So the spending sort of concentrated in areas in which you can spend money, and there's just been an influx of monetary flow into that sector.
And has the fund been able to capitalise on that? I mean, you mentioned you're up nearly 10% in July and you're up again in August so far. How have you capitalised? You obviously have been able to capitalise on it, but how have you capitalised on that and taken advantage of it?
Yeah, look, I mean, we had a reasonable holding in JB Hi-Fi, which performed pretty well, but we've since sold out of. We've had a couple of, I suppose, financial services businesses that have benefited greatly from the spending. But also where we've seen quite a bit of benefit is in the online education sector, whereas I think all the move to online education has meant anything that's kind of leveraged to that sector has really captured the market's attention. And I think quite rightly that these businesses have been given a huge step up in their potential business development cycle, and so the market's reacted to those and they've performed very well as well. So it's not like we've just been in one sector that's been going really well. I think across the board we've had a number of businesses that have performed quite well, but importantly we've been also avoiding certainly the travel sector. I think some of the lending sector's been under a little bit of pressure, and so as always it's a matter of trying to back the winners and also avoid the losers, and I think we've been doing both of those things reasonably effectively, which has contributed to some good returns of late.
On the negative side, have you had to cut out of any positions because they haven't performed well? I mean, you might have taken some profits, as you mentioned on JB Hi-Fi, but have you been caught by anything that hasn't performed the way you'd hope it would?
Look, there's been a few businesses, not terribly many. Probably our main one has been Victoria Offices, which is a co-working space, and that industry has been completely decimated. So really through no fault of their own, but they were a business that was really, really in the eye of the storm. They managed to raise more capital to get the business through I suppose the next wave of COVID. We didn't subscribe to that placement and actually sold out of a holding and took a pretty significant loss. It was our greatest negative contributor for FY20, but importantly we did that before the end of July, so got a benefit of the tax loss, and we've moved on. So that's probably the main one, but most of the others we've been pretty lucky or smart to have avoided.
Well, let's put it down to smart, not luck. You've been doing it for long enough; it should be smart. And on the positive side, what's come into the portfolio on the positive side?
Yeah, so we've had a very successful investment in a business called QuickFeed, which is in almost the sort of business to business, almost a buy now pay later kind of space, and that's been moving into the US, clearly a very big market. The markets have jumped on that bandwagon, and the amount of, I guess, progress they've been making signing on new clients over there. We've made a small investment in Kit McGrath, which is online tutoring. So obviously, huge growth in that industry, both here in the UK. They're benefiting greatly. A couple of others are City Chic, which is a sort of a larger women's retailer, fashion retailer, and that they've been again doing pretty well. And lastly, we've had this really small little kind of food business, a company called New Zealand Coastal Seafoods, which was a tiny investment in our portfolio. It was a very small business. It was only capped at about sort of $7 or $8 million, and that's sort of gone up about 3 or 4-fold in the last month or so as they've signed a couple of contracts into China and more recently Europe, and that again sort of really captured the market's attention. And these really small businesses, like, you won't get a lot of them to go really well, but when they do, they can really contribute greatly to the return of your portfolio, just because they can go up incrementally from very, very low bases.
Really interesting, Dean. And is it sort of more of the same going forward? We mentioned earlier that sort of concern about the mismatch between the market and the economy. You think that's just going to continue? It's going to be select sections of the market that are going to do particularly well?
Yeah, look, I think as the market continues to I suppose, rise and, valuations probably become a little bit more stretched, everything becomes a bit more tenuous. And I wouldn't say you become more nervous. You just need to be very careful about where you've invested. I don't think you want to sit back saying, wow, last month we had a great month. Gee, aren't we clever? Let's just roll with it. I think you've really always got to be reassessing the valuations, the prices of things they're trading at, and adjusting your weightings, if not selling out completely stocks that you think have become overvalued. Now, that's the beauty of the stock market, is you can make incremental changes to your portfolio or your holdings over time. It's not a in or out decision. And so I think you've got to do that more regularly and more critically when the market's running, and certainly in a backdrop of an economic environment that's going to throw up a lot of challenges to a lot of businesses, and there's going to be a lot of a flow-on effect there. So we think that's really important. But again, the market's in a really good frame of mind. So there's plenty of money to be made in the short term as well. So I don't think you want to have one foot in either account, because there's great opportunities and great risks, but just be conscious about both.
And there's plenty of liquidity around in these smaller stocks?
Yeah, heaps. Like, what we've seen is, and we've seen the data on this, that CommSec and other small online trading accounts are signing up more customers than they ever have. I think as people have been at home, they haven't been able to gamble on the pokies or the most sport and stuff. They've actually turned to online trading accounts. The data's there that online trading day trading is now a really big thing, and that's transpired into a lot of liquidity in the market. And it's healthy. Like, it does add to the volatility, but certainly if businesses like ours that want to transact a number of shares, if we decide to make a move, the liquidity is there to do that. So it's actually a really, really good thing for us to operate.
Interesting. What about your cash holding? You've always held a lot of money in cash, or a lot of the portfolio in cash, relatively speaking, so that either because you don't want to invest it just for the sake of it, or so you can wait for opportunities. What's your current cash level, and do you see that continuing?
Look, it's currently sitting at about 26%. It's been interesting that the cash weighting is actually moving around a lot, not because we're buying or selling stocks, but because the value of the equity has been rising quite greatly, and cash obviously doesn't move. So when you have a month, you have 6 weeks worth of funds up 15%, that expands the equity, and the cash weight decreases. We haven't really had a huge amount of confidence to deploy great swaths of cash into the market because there are those uncertainties. Conversely, we haven't wanted to be sell out of everything and saying it's all got too hard, because there's clearly some really, really good opportunity to make some significant returns. So we've still got a foot in both camps, but I think that's probably a pretty sensible way to operate.
Dean, it's always good to talk to you. Thank you so much for your time. You stay safe down there in Victoria, and we'll look forward to speaking to you soon.
Yes, thanks for the opportunity to chat again, Chris, and
okay.
Good luck to everyone out there.